As tensions between the U.S. and its trade partners rise, Canada is making a decisive shift, redirecting its oil and gas exports toward Asia. Starting in April 2025, over 4 million barrels of oil per day will vanish from U.S. supplies. So, what exactly is happening? With a new phase in the tariff war underway, Ottawa has made a bold move. Since April 2025, Canada has stopped prioritizing crude oil shipments to the U.S. Instead, it's rerouting much of its supply through the newly completed Trans Mountain expansion, unlocking access to high-demand Asian markets. This redirection is a direct response to the 25% tariffs imposed by the Trump administration in late 2024 on Canadian oil, steel, and lumber. The tariffs forced Canada to seek out new reliable energy buyers, and Asia was ready. Canada's pivot has shaken oil markets and triggered a massive $1 trillion geopolitical power shift. It's impacting trade flows, reshaping energy routes, and even giving countries like Russia room to test NATO unity. How will this evolving trade conflict play out? Let's dig deeper, right here. In May 2024, Canada officially launched commercial operations of the Trans Mountain expansion after over 12 years of planning. The final cost ballooned to 34 billion Canadian dollars, nearly 5 times its original estimate of 7.4 billion. The expansion tripled the pipeline's capacity from 300,000 to 890,000 barrels per day. That's enough to reroute nearly all of Alberta's oil that once headed to U.S. Gulf refineries. Now it's going west to Vancouver and onto tankers bound for Asia. Instead of arriving at ports across the southern United States, Alberta's oil now moves to the Westridge Marine Terminal in Vancouver. Shipments began as early as May 2024, marking a historic realignment of Canadian exports. This isn't just a new logistics path, it's a major geoeconomic play. With China increasing its demand for heavy crude and other Asian countries like India and Japan looking for stable sources, Canada is stepping in. Oil trains crossing the Fraser Valley headed westward aren't just moving product, they symbolize a major national shift. Canada is betting big on narrowing the discount on its crude, once averaging $13.50 under WTI, to under $10 per barrel. Now that TMX is fully operational, the change isn't just physical, it's strategic. Canada is backing away from its deep energy ties with the United States and embracing Asia, where deals can be worth hundreds of billions annually. TD Securities projects Canadian oil output will hit a record 5.3 million barrels per day this year as producers ramp up to fill the expanded pipeline. This is a huge win for Alberta, said Premier Danielle Smith, highlighting how it will allow the province to significantly boost production. Before tensions, Canada supplied over 60% of U.S. crude imports, about a quarter of all U.S. oil imports. But new EIA data shows U.S. imports from Canada fell to 3.1 million barrels per day, the lowest in 2 years. This drop spells trouble. Many Gulf Coast refineries are built for Alberta's heavy crude. With lighter U.S. crude as the alternative, they face either reduced capacity or costly adjustments, pushing up operational expenses. One immediate effect: gas prices. As of January 2025, the average U.S. price for regular 87-octane gasoline has climbed to $3.15, a 1.8% rise. Analysts warn it could reach over $4 in states like California and Hawaii if shortages continue. For everyday Americans, this means more expensive school runs, deliveries, and weekend drives. As energy costs rise, inflation could accelerate across multiple sectors. Since TMX began shipping oil to Asia, the region's top economies, China, India, and Japan, moved fast to secure long-term contracts. Asia is quickly becoming Canada's new primary customer. Between June and October 2024, China imported an average of 187,000 barrels per day of Canadian heavy crude, making up nearly 55% of Canada's total exports to Asia. One major buyer, Rangan Prochemical, took 3 to 7 cargoes monthly, replacing Middle Eastern oil. In India, Reliance Industries signed its first TMX oil deal in July 2024 for 2 million barrels, opening the door to larger future volumes. The company gained a $5 to $6 per barrel discount over Brent, increasing its margins. Japan's Enos partnered with South Korea's GS Caltex to split a 550,000 barrel shipment. Enos received 250,000 barrels in September 2024, the first TMX cargo ever sent to East Asia, marking a milestone for Canada's presence in that region. These deals collectively account for nearly 500,000 barrels daily. At an average Brent price of $75, that could mean over $1 trillion in trade over the next decade. It's a subtle but serious challenge to the US-dominated global oil network. So what's your take on Canada's big energy pivot? Leave your thoughts in the comments and let's unpack it further, only on Deep State. Instead of hurting Canada, the 2024 US tariffs sparked a surge in demand from Asia. In March 2025, TMX exports jumped to 246,000 barrels per day, up 29% from February, the highest since TMX began. The timing was no coincidence. The US imposed a 10% tariff in early March, but Asian buyers eagerly grabbed discounted Canadian oil. Major players like Suncor and Savas gained $5 to $7 per barrel over Brent, while Ottawa's revenues from tariffs and fees grew. Far from backing down, Ottawa doubled down. In early 2025, Trans Mountain began studying upgrades to boost capacity from 890,000 to over 1 million barrels daily within 3 to 5 years. Rather than weaken Canada, the pressure from US tariffs strengthened its global export game. TMX helped Canada shift its strategy, not just its shipment routes, investing in long-term infrastructure. As Canada turns to Asia, Russia is filling the gap in the US market. Reuters reports Russia's crude exports will rise by 100,000 barrels per day, reaching 1.97 million daily by April 2025, even with OPEC plus cuts in place. Meanwhile, Arctic tankers moved over 20 million barrels to China in April 2025 through ship-to-ship transfers, dodging sanctions and proving Russia's flexibility. Russia isn't just focusing on Asia. As melting ice opens up the northern sea route, global powers are scrambling to develop it. This Arctic corridor offers a faster path to Asia and reduces reliance on traditional choke points like the Suez Canal. Canada isn't sitting idly by. In response, it's boosting investments in Arctic security and infrastructure. From cutting-edge radar to new icebreakers, Ottawa is preparing to secure and support this emerging shipping route. This opens the door to a possible new Arctic oil alliance. Russia brings deep energy reserves and Arctic drilling expertise. Canada contributes its Pacific-linked Trans Mountain pipeline. Now add China, the world's top oil importer, and you have a powerful three-nation bloc. Together, they could control energy flows worth hundreds of billions annually, challenging NATO's existing energy strategy in a time of changing global power. But is it that straightforward for Canada? The Trans Mountain expansion has ignited fierce opposition from local and environmental groups. Critics argue it will only increase emissions from Alberta's oil sands, which are already 6 times dirtier than conventional crude. Others warn of serious threats to coastal ecosystems in British Columbia. Even more urgent is the backlash from Indigenous communities. The Squamish, Tsleil-Waututh, and Coldwater First Nations have united in resistance, filing multiple lawsuits against the pipeline. They argue the government pushed the project through without properly consulting them or respecting their land rights. These aren't just symbolic gestures. Court challenges could pause construction for months. Meanwhile, protests continue across the route. From demonstrations in Kamloops to protest camps at Vancouver's Westridge Marine Terminal, Indigenous groups and environmental activists are physically blocking construction. Some have occupied sites for days to stop machinery. In response, Ottawa deployed Indigenous monitors and environmental observers to manage tensions. But that hasn't cooled public pressure. Without a clear plan to share benefits and protect sacred lands, the pipeline still faces serious risk of delay or total shutdown. The big question now is, can the federal government build a consensus that works for everyone? Or will Trans Mountain go down as a billion-dollar failure caused by ignoring Indigenous and community voices? If Canada wants to accelerate toward energy independence, this is an issue it must solve, and fast. Time is not on Canada's side. The global crude market is entering a major shift that will shape the next decade. The International Energy Agency forecasts oil demand peaking at 105.6 million barrels per day by 2029, then gradually declining post-2030. The reason? The rise of electric vehicles and clean energy initiatives could slash global demand by up to 5 million barrels per day. And Asia, the very market Canada's betting on, is going green fast. China, which commands 60% of the global EV market, wants 1 in every 3 new cars sold to be electric by 2030. India, with only 2.5% EV adoption in 2024, is aiming for 30% by the same year. As these massive economies move toward EVs and biofuels, oil demand in OECD nations may fall faster than expected. That's a problem for Canada's $34 billion TMX pipeline. It was built to export heavy crude from Alberta. But if Asia follows Europe and North America into a cleaner energy future, the pipeline might end up underused post-2030. Canada could be left with high upkeep costs, too much capacity, and not enough buyers. This is the long-term issue Ottawa must solve, or risk the TMX becoming a stranded asset in a rapidly changing energy world. Meanwhile, Brent crude prices have surged nearly 8% since early 2025, climbing from $72 to nearly $78.50 per barrel by mid-January. This spike is driven by fears over global supply and mounting geopolitical stress. This price hike isn't just hurting importers, it's reshaping global oil logistics. Canada now plays a stronger role in Asian energy flows. Meanwhile, Europe, cut off from cheaper Canadian oil, is turning to more costly suppliers in the Middle East and Africa. Reuters reports that due to sanctions on Russia and disrupted U.S. trade, Europe's refineries, especially in Germany, Italy, and France, have seen their input costs rise by $3 to $5 per barrel. That's tightening profit margins and nudging fuel prices higher across the continent. Shipping routes are changing too. U.S. tankers now have to sail through the Panama Canal or around Cape Horn to reach Asia, delaying deliveries and clogging ports like Vancouver and Burnaby. Meanwhile, shipping costs are spiking. VLCC rates from the Middle East to China are up 39%, reaching $37,800 per day. Freight from Russia to China has more than doubled. These disruptions are adding $2 to $3 per barrel in shipping costs, pushing global fuel prices even higher. With oil prices up, European buyers squeezed, and supply chains under pressure, global energy markets are entering a period of growing instability. Canada now sits at the center of this shift, positioned as Asia's gateway, but facing rising complexity. Importers, exporters, and carriers all have to adapt fast to this volatile new landscape. The world is entering a more chaotic and unpredictable energy age, and Canada's choice to break from the U.S. wasn't just a reaction. It kicked off a $1 trillion geoeconomic shakeup. Over 4 million barrels a day have been redirected from North America to Asia. Washington, once confident in Canada's steady supply, now faces higher gas prices, feedstock shortages, and inflation pressures. Meanwhile, Ottawa has seized the moment, expanding infrastructure, locking in major deals with China, India, and Japan, and even exploring deeper ties with Russia. So in this massive energy chess game, who moves next? Will the U.S. pressure Canada to return? Or will Ottawa keep straddling the line between Washington and Beijing, reshaping global oil trade for the 21st century? Subscribe to stay on top of how this plays out, plus all the latest in geopolitics, defense, and global markets.